Hey guys, what's up? This is Tony from alphapursuits.com. In this video, I'm going to talk about the strangle trades that I've been doing recently. So in the last video, I talked about why I'm selling strangles with longer time to expiration options. And since then, I have closed down quite a lot of positions. So I want to share with you the results and also talk about some of the analysis that I did. So as you can see, here's a list of options that I traded recently, and I recorded when they were open and when they were closed, and how many days it took to the duration of the trade, and then margin requirement. And based on that, if I want to get out a 35% profit, what that amount would be, and then the actual P&L, how much I made, how much I lost for each trade, and then return of investment. So I wanted to annualize to see, okay, if I do this particular trade, it took 46 days, which means it was equivalent to 17%. And when I annualize it, so if I continue to do this kind of trade every 46 days, and then it will be 139% annualized. But of course, it could go to the other side, right? I mean, if you look at this large lost positions, and you can see if I annualize it, if I keep continue doing that, you'll be minus 800%, which of course it doesn't make sense. But so it's just a number that I like to look at to see, okay, if I continue to do this kind of trades successfully, what kind of annualized return I can get. And I want to draw your attention to these two very important numbers here. So Vega, which is basically the Vega of the option for both call and put side. So I add them up, and this is what it is. So what we are looking at here is we want to trade a longer time to expiration options with high Vega. So that's the kind of conversation we had in the last video. So in this video, I'm going to show you some of the analysis that I did and see, okay, indeed, if that is the case, is it good idea to trade long time to expiration options with high Vega? If so, what kind of result you can expect based on the data that I have here. And then lastly, the IV percent difference. So all these trades that I did, I got in when the IV percentile was above 70 at least. A lot of them are 80 or 90 percentile. So what we're looking at here is the difference between when I open and close. So you can see, for this one, the very first one, 25%, which means when I open it, let's say it was 100%. When I close it, it was at 75 percentile. So that is basically that difference. And you can see there was one that was negative, which means the IV percentile actually went up. And despite that, I actually made money, which was kind of interesting. So let's take a look at the analysis that I did. So let's take a look at this one here. And it's quite a bit of maths here. So in case if you're not a math person, don't worry about it. I'll go through them and just give you the gist of it. So basically, I only selected the ones that are January expiration or December expiration. So you can see I have the days to expiration. So I basically selected the ones that are more than 100 days. And that's right here, as you can see, day to expiration. So all these options are more than 100 days to expiration. And then P&L and the Vega for each of the option, and then IV difference. So what I did was I looked at the correlation between, okay, the P&L and Vega, the P&L and IV difference. And then I look at P&L on combining these two values. So when we talk about correlation, if there's a positive correlation, that means when I make money, the Vega, so let me go back a few steps here. So the prediction here is that if we trade options with high Vega, we are more likely to make money. And so what we are looking for here is looking for a positive correlation. In other words, when I make money, did it happen to options with high Vega? So that's what we were looking for. That's the first point. The second one is the IV difference. So when the IV percentile drops a lot, we are going to make a lot of money. So that's the hypothesis. And so again, we're looking at the correlation here. When I make a loss, so when I make a lot of money, did the IV drop a lot? Or when I lost a lot of money, did the IV drop less? So that's the kind of correlation we are looking at here. And finally, obviously, each individual ones might give you different results. For example, we talked about earlier here, there's one stock that, it had a very high Vega, but the IV drop didn't drop, it actually went up. So in this instance, what we want to do is we want to combine the two values here and come up with a new value to compare. So that's exactly what I did here. I basically normalized these two values and then, basically use log calculation here and came up with a value that we can compare. So basically we compare P&L and then the normalized value. So if the value is higher, so I made it in a way that, this is positive. If it's higher, it's good. If it's higher, it's good, right? If the Vega is higher, it's good. If the IV percentile higher, is good. So that means when this normalized value is higher, we should make more money. If the normalized value is lower, we should make less. So that's the kind of correlation we are looking at here. So 3 different values we are comparing it to P&L. And here's the graph. So let's zoom in a little bit here to look at these graphs here. So the first one, let's take a look at the correlation between Vega and P&L. So as we can see here, the prediction was higher the Vega, we should make more money, higher the P&L. So as you can see, the P&L is on x-axis here. It's all the way up to 800 and positive 800. So as we can see, when the Vega is low, when the Vega value is low, there isn't much difference. In fact, actually, I lost more money here. Now, when we look at the higher Vega, it seems like I do make more, I do win more, so to speak, right? And then the other one that we look at here is the correlation between P&L and the IV difference. And again, same kind of result here. As we can see, when the IV value didn't drop too much, I tend to lose more. But then when the IV value is higher, I do seem to win more. As you can see here, there's one that's exception. I did lose, even though the IV percentile dropped. I think it was 59 or close to 60%. So as we can see here, so if the prediction both holds, right? Higher the Vega, I do make more. Higher the IV difference, so when the IV percentile drop more, I do make more. So now let's look at when we combine the two. So when both values are higher, what happens? So and that would be this last graph right here. So correlation between Vega plus IV and P&L. So P&L again is on x-axis. And as we can see, when we combine the two values, so when that value is higher, I do seem to win more and make more. So the conclusion here is basically when we are trading longer time to expiration, we need to look for options that have higher Vega value. And of course, we want to sell them at high implied volatility percentile. And when it drops down a lot, we want to get out. So that's kind of the takeaway here based on the data that I got. I hope you enjoy this. And if you have any questions, please feel free to leave in the comment section. And if you do not agree with any of these data results, I would like to hear your input also. So please feel free to let me know, leave in the comment section, or please visit alphapursuits.com and send me an email there. Thank you for watching, and I'll see you in the next video.